Is the U.S. economy facing a perfect storm? Let's find out.
You bet. Financial experts like Adrian and John Rubino unpack the turmoil, inflation, and more.
In this video, we've distilled their key insights into quick takeaways to save you time.
Stick around. We begin with George Gammon as he reveals Trump's sovereign wealth fund proposal.
And later, John Rubino breaks down the recession that everyone is talking about.
Remember, this content is intended for educational purposes only, not as investment advice.
Today, we're diving into Donald Trump's surprising announcement about creating a sovereign wealth fund for the United States.
This initiative sparks curiosity as it challenges conventional understandings of sovereign wealth funds, especially for a country facing a budget deficit.
So, how do sovereign wealth funds usually function? Trump's approach might differ significantly from the typical model.
Unlike countries like Saudi Arabia that fund their funds with surplus, the U.S. may depend on borrowing, setting up a fundamental mismatch.
What kind of assets might Donald Trump target with this fund?
Gammon speculates that Trump could invest in TikTok, cryptocurrencies, and even opt for strategic acquisitions.
Gammon emphasizes the distinction between wealth in terms of currency versus actual goods and services.
He points out that even if Trump successfully grows the fund, the true measure of wealth lies in the availability of goods and services.
Looking ahead, what can we expect from this sovereign wealth fund initiative?
Gammon predicts that if well managed, this fund could yield positive outcomes for American citizens.
Ultimately, Gammon concludes that Trump's ability to enhance American wealth relies on wise investment choices that increase goods and services.
It will be essential for the U.S. government to prioritize these aspects over merely increasing monetary quantities.
Today, we're diving into an analysis of Blackstone's impact on the housing market, as noted by the Reventure consulting team.
The analyst highlights that Blackstone is selling houses at substantial losses, signaling potential trouble for the housing market.
The Reventure analyst explains that Blackstone is liquidating properties purchased at high prices, with sales reflecting discounts of up to 27%.
They're winding down a subsidiary, Home Partners of America, which is expected to flood the market with discounted homes. The analyst noted that investor purchases have fallen significantly, down about 50%, mirroring trends seen just before past housing market downturns.
This suggests that investors may sense an impending market downturn before typical homeowners do. It's crucial to understand how these discounted sales are affecting home prices. Local reports suggest that they could lead to overall declines.
The analyst warns that this could erode homeowner equity, particularly in markets like Florida and Texas, where prices were already overvalued.
The Reventure analyst predicts the coming years might reveal a significant impact from these sales, potentially marking a downturn in home valuations.
This situation may showcase the delayed market response to these losses as inventory remains high and buyer demand stays low.
As suggested, homeowners should actively monitor their property values and be prepared for potential declines.
Investors may need to rethink their strategies, particularly in oversaturated markets affected by Wall Street liquidations.
Today, we will be exploring David Lin's analysis of the labor report and its expected impact on the stock market.
David mentions that the mixed labor statistics might influence market volatility, especially with the tech earnings backdrop.
David Lin highlights that the unemployment rate remains steady at 4%, suggesting a resilient job market.
However, he warns that the rise in hourly earnings may add inflationary pressures, complicating the Federal Reserve's approach.
As discussed by David, the earnings from tech giants like Amazon and Nvidia can greatly influence market sentiment.
Watching their performance will be key to understanding trader sentiment and market reactions.
What predictions does David Lin make regarding market volatility?
David suggests that as markets digest the labor report, heightened volatility could occur, especially around key earnings announcements.
Looking forward, what strategies does David propose for investors?
David recommends that investors brace for potential fluctuations based on the mixed signals from the labor report and earnings.
In conclusion, David Lin emphasizes the necessity for traders to navigate through economic uncertainty.
By focusing on risk management and being aware of Federal Reserve signals, investors can better position themselves in this changing landscape.
Today, we're discussing the imminent recession with John Rubino, an expert economist who offers a stark analysis of the current financial landscape.
John highlights alarming indicators that point toward an upcoming economic downturn, focusing on the fragile state of the housing market.
John Rubino points out that consumer spending is drying up, indicating fatigue amongst buyers in a strained economy.
Additionally, he notes how commercial real estate is significantly over-leveraged, setting the stage for potential disasters. According to John, the housing market has reached historically high levels, making home ownership nearly impossible for many.
He articulates that the failure of the housing market could trigger a national financial crisis. John discusses how the Federal Reserve's rate hikes are dampening consumer confidence, resulting in shrinking spending.
He stresses that this could lead to job losses and further economic contraction. John warns that regional banks are at risk due to rising default rates on commercial real estate, potentially sparking a banking crisis.
He believes these defaults might exacerbate the recession effects and lead to a governmental bailout. John predicts that if the Federal Reserve continues to ease rates, inflation could spike, complicating recovery efforts.
He anticipates a financial crisis spurred by several potential catalysts, including an unsustainable debt burden.
John emphasizes the importance of conservative investing, suggesting a shift towards assets that can withstand inflation.
He advises viewers to consider commodities and precious metals, which might serve as safer bets during economic downturns.
Today, we're analyzing Arch Hawke's insights on the troubling trajectory of the UK economy and recent actions taken by the Bank of England.
Arch notes that the Bank of England has shifted its stance from cautiousness to advocating significant rate cuts in response to evolving economic conditions.
Arch Hawke's highlights a significant reversal in the Bank of England's approach, moving from a cautious to a more aggressive stance.
This shift signifies a grim recognition of deeper economic issues that challenge previous recovery assumptions. Arch argues that the perceived recovery in 2021 was merely an illusion, as the UK faces stark economic realities.
The optimism expressed in previous assessments sharply contrasts with current economic indicators. Arch explains how GDP growth has continually underperformed, signaling deeper economic troubles as unemployment rises.
He suggests that these trends reflect an economy struggling to recover, with a labor market failing to stabilize. Looking forward, Arch predicts continued economic challenges, noting that further rate cuts might be necessary if growth fails to materialize.
This grim outlook highlights ongoing struggles within the UK economy and reinforces Arch's critical perspective on current policies. Arch suggests that ongoing rate cuts may not yield expected positive outcomes and could worsen the economic scenario.
This relationship raises questions about how policymakers will navigate these challenging circumstances moving forward.
In conclusion, Arch Hawke asserts that the UK economy confronts dire challenges, reflecting a transition in central bank policy amid persistent weaknesses.
Arch stresses the need to recognize underlying economic fundamentals, urging policymakers to act appropriately amidst this ongoing struggle.
Today, we're examining insights from Adrian Day on the dramatic shifts in the gold market as recent prices top over $2,900 an ounce.
Adrian underscores that rising geopolitical tensions and central bank purchasing are driving up gold's value.
Adrian Day emphasizes that central banks are a primary factor behind the increase in gold prices, seeking to diversify reserves in light of dollar fluctuations.
He notes this trend reflects a long-term strategy by central banks, revealing robust demand for gold. Adrian points out that along with central banks, there's been a notable surge in consumer gold buying in China amid economic uncertainties.
He also mentions the limited participation of ordinary retail investors in the North American market, which may change.
Adrian discusses the effects of impending U.S. tariffs on gold markets, leading to shifts in sourcing.
He explains these shifts have created notable arbitrage opportunities.
Adrian anticipates a bullish outlook for gold, with possible movement towards the $3,000 level.
He believes that in the long run, prices could climb to $3,500 to $4,000.
Adrian concludes that with gold becoming a solid investment in economic uncertainty, investors should consider reallocating their portfolios.
He advises to keep an eye on global central bank actions as they will significantly affect gold trends.
What an enlightening ride through the world of finance we've had today.
Indeed. Adrian Day, Arch Hawks, and many others shared some heavyweight insights.
Adrian's take on the gold market as heavily influenced by central banks really stands out.
It's fascinating, but Hawks' urgent warnings about the UK's economic situation put gold's rise into perspective, don't you think?
Absolutely. And Rubino's ominous take on the housing market, especially with affordability issues, adds another layer of complexity.
Exactly. While also considering Lynn's perspective on labor data and the stock market impacts, things are definitely intertwined.
And let's not forget about Trump's sovereign wealth fund proposal. It's raising eyebrows everywhere.
For sure, the financing is tricky, especially with a large deficit looming over it.
All these differing opinions highlight the uncertainty in the market, and it's clear that more analysis is needed.
Right? And if viewers found these insights valuable, they should give us a thumbs up.
Like, subscribe, and turn on notifications so you don't miss our upcoming discussions.
Next week, we'll dig into the latest trends in global currency shifts. Stay tuned.
Thanks for joining us, and we can't wait to see you in the next video.